your capital buying options, there is a very high probability you are currently trying to recover that capital by buying more options. Many traders blame a lack of capital for these failures, but the math shows that the instrument's risk profile, not the size of the account, dictates the outcome. This chart highlights the disconnect in retail trading. The vast majority of participation is clustered in option buying, an instrument with a minuscule long-term success rate. In option selling, those metrics are completely inverted. As capital runs low, desperation drives traders toward high-leverage shortcuts, marketed as a way to bypass their depleted accounts. True recovery requires moving away from instruments where structural odds are mathematically stacked against the buyer. The urge to make the money back quickly is intense, and it is that exact emotion that pushes you toward high-risk, aggressive tactics. Currently, the two most prominent traps marketed to traders in drawdown are funded accounts and maximum leverage crypto trades. We are going to compare the structural realities of Indian F&O, these high-leverage setups, and alternative global markets. The goal is to stop gambling for a reversal and start viewing your capital through the lens of objective allocation. Navigating out of a loss relies on a calculated evaluation of market mechanics, rather than luck or a reliance on magic bullets. Let's evaluate the first path, deploying a small capital base, under 50,000 rupees, into traditional Indian option buying. This forces you to rely entirely on intense, immediate directional momentum just to outrun the effects of theta decay. This setup offers infinite theoretical upside, but it carries the absolute lowest mathematical probability of consistent success. So you look at the primary high probability alternative within the same domestic ecosystem, Indian option selling. The capital requirements here are a massive barrier. You need upwards of 1.5 lakh in margin just to secure a few thousand rupees in premium. While your win probability increases, your return on investment is restricted. For an account in deep drawdown, this pace of recovery is often too slow to be practical. The Indian market structurally forces undercapitalized traders into a difficult choice: unaffordable high-probability trades or affordable low-probability gambling. To solve this capital constraint, many traders turn to modern internet shortcuts that promise massive funding for a small fee. In the funded account or prop firm model, you pay for access to a massive simulated trading bankroll. You may see your screen profits grow, but because you are operating inside a simulated environment, those numbers are effectively a video game score. When it comes time to withdraw, many of these platforms use arbitrary rule changes or glitches to deny payouts. The business model relies on you never actually taking money home. The other common shortcut is high-leverage perpetuals, where you use borrowed exchange funds to multiply your position size by 40 or 50 times. This leverage dramatically accelerates account liquidation. While you take all the risk, the exchange extracts heavy interest fees on the borrowed capital. Bypassing capital constraints through funded scams or extreme leverage usually results in lost upfront fees and zero realized bank withdrawals. There is a legitimate alternative, shifting your focus away from domestic indices towards 24/7 global markets using FIU-registered exchanges. This ecosystem provides high liquidity in major assets like Bitcoin and Ethereum. It also includes global commodities like gold and crude oil, which often experience unique news-driven volatility. The primary advantage here is the ability to sell options using fractional capital. You can execute high-probability strategies without the massive margin barriers found in traditional F&O. You also get the benefits of constant market operation and the availability of daily expirations. The trade-off is the learning curve. You must put in the effort to understand new asset classes and unlearn your domestic index habits. This pivot provides a structural edge, allowing you to run a high-probability selling desk without needing a massive starting balance. Here is the baseline rule for trading. Profit is defined strictly by what clears into your bank account. Digital numbers on a screen are not wealth. This standard is why simulated funded accounts fail as a tool for actual recovery. However, for those who have already suffered and filed losses in the Indian F&O market, there is a specific logistical advantage. If those F&O losses were properly filed by a CA as business income, the tax code may allow you to offset them against new profits made in global crypto or commodity markets. By classifying both under the same business head, your previous failures can shield your new gains from taxation. A properly documented past loss becomes a financial asset, allowing the first phase of your recovery to be effectively tax-free. This framework helps you decide where to allocate your capital based on your current status. If your remaining capital is under 1 lakh, route your trades away from domestic F&O and into alternative markets for fractional option selling. If you are tempted by shortcuts, prioritize strategies that offer guaranteed bank-realized payouts over simulated prop firm numbers. Take a physical break from the charts to internalize these mechanics before you place another trade. Successful recovery happens when you move your capital to markets where the structural odds actually align with your strategy. Break the cycle of buying high-risk instruments and start trading where the math supports your success.